Oil jumped on news that Israel struck targets in Iran as a response to last weekend attacks, and gold gained. The US dollar gained as well yesterday on the back of another set of strong economic data from the US, while TSM results failed to impress investors yesterday after ASML disappointed earlier this week, remember. And finally, Netflix second quarter forecast came in a bit shy of analysts' expectations and casted a shadow on another quarter of strong subscription growth. So as you see, we have a busy agenda and a lot to talk about for today's episode. So tune in. This is Swissquote's Daily Market Talk. So as I said, we have a lot to cover today with the TSM earnings, the market reaction to these earnings, another surprise quarter from Netflix and its monthly subscriptions, the economic data from the US, and the Fed comments. But I will start today's episode with rising geopolitical tensions on news that Israel struck targets in Western Iran as a response to last weekend's attacks from Iran on Israel. So one of the concerned cities is apparently Isfahan, which is home to several military bases and facilities in Iran, but which is also home to nuclear facilities, including the main technology center. Now, Iran said that the nuclear site is safe, happily, and Bloomberg journalists highlighted this morning that as Iran's last weekend attack, which was designed to warn rather than destroy, while yesterday's Israel bombing in Iran remained in the realm of gaming out calibrated actions to send messages without, however, raising stakes. But obviously, uncertainty looms. Brent crude traded above the $90 per barrel level before easing to around $88.50 at the time I'm talking here. US crude shortly traded past the $86 per barrel level. Wheat futures jumped 2%, while gold rebounded to a near record level. And finally, Swiss franc also gained. Now we could see a further flight to safety and safe haven assets before the weekly closing bell on fear of further escalation of these tensions in the Middle East during the weekend. And obviously, shorting oil and gold looks risky at the moment as the Middle East is obviously boiling, and having exposure to these commodities, a positive exposure, is instead a good hedge against the rising geopolitical tensions and risks in the region. Now, voila, that's the geopolitical news. In other hot commodity news, while cocoa futures jumped close to 10% at yesterday's trading session to above $11,000 per ton level, and a hedge fund manager called Pierre Endurant said that the cocoa shortages will likely push the price of a ton of cocoa to $20,000 per ton. So for those who love speculation and adrenaline in the markets, cocoa futures is the place to be right now. Elsewhere, well, technology investors didn't necessarily bought into TSM's better than expected revenue and better than expected earnings compared to the same time last year. They were rather quite disappointed with a 5% decline in revenue and income compared to the last quarter, so compared to the fourth quarter of last year. Now, the company, TSM, dialed back its outlook for the chip market expansion, and that was due to weakness in smartphones, personal computers, and the car industry. And yes, we all know that Apple, which stood for about a quarter of TSM's revenue last year, kicked off this year with a 10% slump in its iPhone shipments, and Tesla, which is another client of TSM, saw its first quarter deliveries tumble by 8.5%. But don't despair, because TSM thinks that accelerating demand for AI chips should compensate for that weakness in other areas, and the company keeps its spending plans intact for capacity expansion and upgrades, and they also expect their revenue to grow at least 20% this year, which is not bad, but alas, anything less than absolutely mind-blowing is not enough for the chip rally to continue, given the latest exponential rise that we saw in stock prices. So TSM shares fell nearly 5% yesterday after the results, while Micron Technology which was previously up pre-market on news that they will get more than $6 billion in grants from the US government for their domestic factory projects in the US, well, ended up falling almost 4% in the session. So mood in chip stocks wasn't great yesterday or this week altogether. The S&P 500 extended losses and Nasdaq 100 retreated to near its 100-day moving average. And the US futures are in the negative at the time I'm talking here this morning, and that's on the back of a broad-based retreat in global risk appetite due to rising geopolitical tensions, less than mind-blowing quarterly results from some chip stocks and chip machine making stocks, and strong looking US economic data that further challenges the Federal Reserve's rate cut expectations for this year. In the sense, US jobless claims came in lower than expected yesterday. The Philly Fed Manufacturing Index unexpectedly jumped, and the Federal Reserve's Raphael Bostic said that he doesn't expect a rate cut until the end of this year. Then his colleague Neil Kashkari said that the Federal Reserve could potentially hold this rate steady all of this year, and the Fed's John Williams said that there is no urgency to cut the interest rates in the US, but that he doesn't rule out a rate hike, though this is not his base case scenario. But despite all the hawkish voices, the US 2-year yield remained capped near the 5% psychological mark yesterday, and that despite the strong economic data from the US and hawkish comments indicating that, well, investors are now quite hesitant to give up their final hope of seeing the Federal Reserve losing its monetary policy this year. The Eurodollar is under a renewed selling pressure this morning as the divergence between the hawkish Federal Reserve and dovish European Central Bank expectations continues to justify a further weakness in the pair. The yen, on the other hand, remains offered as core inflation in Japan is more than expected by analysts to 2.6%. So we are still waiting for the Japanese authorities to come in and to stop the bleeding in the Japanese yen, as they said that they would if the sell-off in the yen became unsustainable. So I don't know what they are waiting for. Now back to the big technology space. Netflix reported results after the closing bell yesterday, and they actually surprised with yet a third month of blowout growth in their subscriptions. The company added more than 9 million new watchers on their platform in the first quarter of 2024. Hence, they posted their best start to a year since the pandemic. The password sharing ban obviously continued to boost these Netflix subscriptions, as company estimated that they were around 100 million people using a Netflix account without paying for it. And it actually looks like the password sharing ban convinced a lot of these people that Netflix is still worth paying for. But unfortunately, well, Netflix lost almost 5% in the after-hours trading yesterday as the company's second quarter revenue forecast failed to impress investors. So they also said that they will unfortunately stop reporting their quarterly subscribers next year. What a disappointment, really. That was the most interesting thing to watch in Netflix quarterly results. But anyway, in terms of market pricing, Netflix will likely slip below its 50-day moving average today, and the toppish signs goes beyond Netflix, mind you. The rising hawkish voices from the Fed back further weakness in stocks, especially in the rate-sensitive technology stocks. And unfortunately, the quarterly results from the world's leading chip and chip equipment makers like TSM and ASML failed to satisfy investors this week and set the tone for a maybe, but just maybe, challenging earnings season for the rest of the chip industry. And if that's the case, well, we could see the risk rally fade away into May, which is known to be the month where investors sell and go away. So voila, this is all for this week. I am İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button to let us know that you enjoy these videos. So I will meet you again next week, and until then, good day trading and have a lovely weekend.